Good afternoon, everyone. Welcome to the third installment of our webinar. We're going to give it just another couple minutes here for anyone else to join us, and we'll get started shortly. Alrighty. Well, good afternoon, everyone, and welcome to the third installment of our webinar series, Leveraging Your Data to Benefit Your Stakeholders. I'm Jacob Wales, a financial analyst for 3+one, and I will be your host today. It is my pleasure to introduce you Garrett Macdonald, Senior Vice President of 3+one. And before we get started, I'd like to share a little bit about Garrett with you. So Garrett has been partnering with public officials to generate measurable and sustained public value through increased interest earnings and savings since joining 3+one in 2015. Prior to joining 3+one, he traveled widely, both domestically and internationally, bringing efficiency resource management to nonprofits in places as far-flung as Singapore, Indonesia, and Great Britain. Garrett attended St. John Fisher College here in Rochester, New York, where he graduated magna cum laude with a BS in corporate finance. He then went on to earn his MBA there with high distinction. While at Fisher, he received recognition for his scholastic accomplishments and community service. And Garrett was also invited to join Beta Gamma Sigma, the highest honor that a business scholar can receive from an AACSB accredited institution. He was a research contributor to and co-author of a textbook, an academic publication that concentrated on financial instruments and corporate sustainability. Through the Association of Finance Professionals, Garrett earned his Certified Treasury Professional designation and also earned his Certified Corporate Financial Planning and Analysis Professional designation. He earned a certificate in Artificial Intelligence Implications for Business Strategy from the Massachusetts Institute of Technology, and most recently in April of 2020, Garrett earned a master's certificate from Colin Powell's High Performance Leadership Training Program. If you have any questions, we've allowed 10 minutes at the end of this presentation, and we'll open the floor to any questions that you may have at that time. In the meantime, feel free to ask any questions that you have during the presentation using the question function in this presentation, and we'll make sure to get to them at the end of the webinar. Garrett, how are you doing today?
Great, Jake. I'll tell you, there's very few things that are worse than listening to someone read a bio of you. So I feel bad that you had to go through that, but I appreciate that. That's very kind of you. And thanks for hosting today's webinar, my friend.
Thank you and everyone else for coming today. So Garrett, I've got just a few questions lined up for you that I want to ask. And to start, what exactly is the cashVest score?
Thank you for asking that question. Today's webinar it's so fun and interesting because we've come up at 3+one with these new opportunities to measure performance on cash and to maximize the value on cash. And when 3+one came up with the cashVest score, it's really important to think about someone paying, for example, tuition dollars or tax dollars. Really, anyone turning over funds to you as a finance officer, as a CFO, they really have trust that when you're collecting those funds, that you're also doing everything that you can to utilize them in the best possible way, right, Jake? When something's vested, it's having the trust, it's having the knowledge, knowing that that particular something is protected. Vesting can be granting possession or even authority over something. When you become vested in someone, right, you're particularly interested in them, you're particularly interested in their success, their protection, even their improvement. And when you become vested with tuition, tax dollars, or whatever sources of revenue you're collecting, you're being trusted to protect and improve that cash or that position. So the cashVest score was created to provide a really quick snapshot of how to gauge the success, the improvement, and the protection of cash. It's vesting your cash with all the tools and all the data needed. So as a finance officer, you have a really quick FICO score like tool to measure the success of your cash. And it's a tremendous amount of data and analysis that goes into determining a cashVest score. It can range from 10, although we've never had an entity receive a 10, to a 100. And we have had an entity to receive a 100 cashVest score, Jake.
That's fantastic. And to touch a little bit on how you mentioned there's a lot of data and everything that goes into determining this score, what exactly are the elements that make up an individual cashfest score that go into that number?
So this is where the fun starts, right, Jake? And we're going to do everything we can to, we promised a 20-minute webinar. We're going to be even shorter than that today because I like to exercise brevity. There are 5 main categories of the cashfest score. Now, if you're listening today and you're a client of 3+one, hopefully this provides a unique perspective on really how to hone in on some of the different aspects, the different 5 elements of the cashfest score. If you're not a client of 3+one, that's great. We hope that this provides some education on maybe some different things to look at and to pay attention to, and ideas on how you can really begin to take advantage of a very changing financial marketplace today. And we really are in a changing marketplace today with Fed raising rates, with a lot of media outlets suggesting that rates are going to climb even more precipitously than we had originally thought. But the 5 different elements of the cashfest score include: 1, percent of available funds providing value. Now think about that for a second, right, Jake? Are all of your funds providing value? It might seem like an odd question, but anyone who manages public funds knows how difficult it is to always confirm that all cash is providing value in some way. And that doesn't always mean interest. For example, you can have cash earning 15 basis points in interest, but your bank may be providing you 30 basis points in an earnings credit rate. And in that case, the percent of funds offsetting your banking services through a 30 basis point earnings credit rate is actually performing better than the 15 basis points earning interest because it's higher. So it's really difficult to continually measure that. And with rates climbing, it's going to be candidly tough to keep up. And so that's what the cashfest score does to you. That's what this particular element of the cashfest score does for you. If your bank doesn't provide bank billing statements with stated fees or an earnings credit rate, do you have a negotiated level on deposit required to offset your banking services? And, we've worked with entities all across the country, and some of them say, well, we don't pay banking fees and we don't have a negotiated level of deposit to offset our banking fees. And that's great. And if that's the case, then I would have a conversation with your banking providers and say, you know what, in that case, I want to earn as much interest as I can on every dollar that I have. And if they say that's great, then you're really going to be ahead of the game. And if they say, I'm not sure about that, then ask them why. Because if the market benchmarks say that you can earn 40 basis points in a liquid rate, but your bank wants to provide you with 20, there's a 20 basis point opportunity cost. So it's really just looking and measuring at the percent of available funds providing value. The second, liquidity proficiency. Are you too liquid? Are you not liquid enough? If you have all of your cash earning, as I mentioned, 40 basis points today, and it's all liquid, are you too liquid? How do you answer that question? It really is an interesting question to answer. What's the time horizon of your cash from the moment you take $1 in deposit to the moment you expend that dollar? How long do you have it? If you have it for a week or a month or 6 months or a year, there is a value associated with that time horizon. And as you continually calculate it, this element of the cashfest score highlights if you're taking the greatest amount of advantage of that time horizon. So liquidity proficiency, are you too liquid, not liquid enough? I've been in situations, Jake, where I've asked that question, are you too liquid? Are you not liquid enough? And sometimes it's like, boy, that's really odd. I've never thought about that before. but especially in a changing marketplace like we're in especially in a time where many entities have more cash than they've ever had before. It's really important to ask yourself that question. Are we too liquid? Are we not liquid enough? Are we taking advantage of our financial providers to use the time horizon of our cash? So that's liquidity proficiency. The third element is the Wernick rate indicator. And Jacob, as you know, many of our services and data points here were created by the users of those services and data points. And this is actually one of them. So the late Treasurer Tom Wernick of Wayne County, New York, asked us to make a distinction between the interest rate he was earning on his cash that was earning interest and compare that to the effective rate he was earning on all dollars under the county's purview and how that compares to benchmarks. Now, let me say that again. He asked us to make a distinction between the interest rate he was earning on just the cash that was earning interest and compare that to the effective rate he was earning on all dollars under that entity's purview and compare that to the benchmarks. This is a really different way of looking at cash. Many CFOs say, yes, we're earning great rates on that 10 or 50 or even, we've seen it as high as 500 or $1 billion that an entity has in quote excess cash, and that's great. But what about all cash? How are we measuring the difference? And how are we comparing that to benchmarks, Jake? The Wernick rate indicator differentiates the difference between and provides an approach on how to execute what will benefit your entity the best when it comes to rates. Very important aspect and element of the cashVest score because of where we are in this environment. The fourth element, cash flow optimization. Really simply put, how well and efficiently are you bringing in dollars? Are you holding dollars? Are you dispersing dollars? And how are you looking at your overall account structure? So entities that we work with say that this particular aspect of the cashVest score has been really helpful in a post-COVID finance office where, we were talking about ZBAs and controlled disbursements and your check to ACH ratio and how to operate in a virtual finance office. And, candidly, not a lot of entities wanted to hear much about it, Jake, but in a post-pandemic world, it's really important to identify how effectively and efficiently you're bringing in cash, you're holding cash, and you're dispersing cash. And that's what cash flow optimization looks at. And then finally, the fifth element of the cashVest score is one of my favorites, and that's investment policy. Many entities have an investment policy, but asking yourself, does it match, if you're a public entity, does it match state law? If you're a higher ed institution, it could be we need an investment policy or even a liquidity policy to make sure that you have an outline and a framework to ensure that your team is all on the same page with how you're maximizing the value on cash. Do you have the necessary guardrails? Do you have the necessary metrics in place? And how does this compare to peers? Meaning, how does your investment or liquidity policy compare to your peers? And this particular element of the cashVest score measures that. So I hope that wasn't too long, Jake.
No, that was actually a very nice explanation of all the different components. So thank you, Garrett. And with all that in mind of everything that goes into the score, this score is also acknowledged by the National Association of Counties. And why is it that they also recognize this score as a good metric?
Thank you for mentioning NACO. So the National Association of Counties is really important. They're a partner of 3+1. We're honored to be endorsed and considered a best practice by NACO. And I'll tell you a little bit about the rationale behind that. But the score transcends all entities. It could be used for towns, for villages, for authorities, for school districts, for higher ed. All of our client base consists of all those different types of entities. and it's utilized across the board. NACO, though, has a great value statement, Jake. And what it is it's advancing excellence in public service to help people and places thrive across America. Boy, I like that. That just kind of gives me the tingly feeling, right? And on top of that, NACO provides performance priorities for its memberships, particularly finance performance priorities for its memberships, with the goal of, it says, optimizing county resources and cost savings. And that's exactly what cashVest does, using those 5 different elements, right? Percent of available funds providing value, liquidity proficiency, Warnick rate indicator, cash flow optimization, and investment policy. It's optimizing county resources, cash, and cost savings, looking at every opportunity to reduce fees, increase income. And that's really why it's acknowledged as a best practice by NACO and other organizations across the US.
Well, thank you, Garrett. And also, to get kind of more into the nitty gritty, let's say I'm an entity that just received my cashVest score and I see this number presented before me with all these categories you were just breaking down. What exactly does the score mean to the entities that 3+1 serves? What would that score mean to me as an entity?
Um, it's peace of mind. It's performance. It means implementation, because you're not alone. It means confirmation that you're doing everything you can to maximize value on cash. It's meant to get whoever's looking at their cashVest score excited. There's nothing better than seeing your cashVest score incrementally increase over time. It means accountability, Jake, right? We're accountable to the entities that we serve, and they're accountable to us, because we're constantly working with them to try and look at different ways to provide efficiencies and improvements. So it's a transparency, evidence-based tool. That's what it means to the entities that we serve.
And what if I get, say, my first cashVest report and I see that I have a low score? Does that mean that things are going terribly, or what does a low score mean?
There are no such things as a low score, Jake.
That's right.
Um, I'll be self-deprecating. First of all, I would think long and hard before I decided to run a marathon. Okay. Anyone who knows me, for obvious reasons. But if I did, even if it took me a little bit longer, it would still be a big accomplishment that I made it over the finish line. It'd be a big accomplishment that anyone made it over the finish line. And in that, it's similar to cashVest, the cashVest score. This is a journey, Jake, right? This is an on-demand decision-making tool to help you execute borrowing, investing, and cash management decisions with more confidence and greater ease. But it starts with a journey, and it starts with taking that first step over the start line. And when you're doing that, you make tiny little improvements along the way. And even if it starts out a little low, even if you start that marathon a little slower than what you had hoped, we always hope to get over the finish line. And with cashVest, that absolutely is a reality. So there are no low cashVest scores. It's just realizing that the entities that we serve are going 1,000 miles an hour in 1,000 different directions. So we're just saying, start the journey. Let us help you with that on-demand decision-making tool to help you execute investing and borrowing and cash management decisions with more confidence and greater ease. Very important, again, for our current clients, who we have a lot on the line today, because if you're getting your cashVest score quarter to quarter, month by month, whatever cadence you're on, and it's not going up as quickly or as high as you would like, we're on this journey together. So let us work together to make it happen. And we promise you that when you do that and you embrace that journey and that process, you will always earn and save the most you can for your taxpayers.
Well, thank you, Garrett. That happens to be all of the questions that I currently have for you today. And now we're going to open up the floor to if any of our attendees have any questions for you. Firstly, I just want to say we hope you enjoyed this presentation so far. And by the end of the presentation, you don't have to have thought of your questions now. If there's any you forgot to ask, please feel free to reach out to us at any time. And our next installment is going to be called Forward Forecasting and How It's Calculated. Where will my balance be next month? Which will be hosted by Kyle Metcalf and is scheduled for April 28th at 2 p.m. And we hope you'll join us then.
Yeah, Jake, I just want to tell everyone, please put that on your calendar, and we hope to see it. And thank you to everyone who took a few minutes out of your day today. We have friends watching and wonderful people that we serve all across the country. So thank you. And if we don't currently serve you and you have any questions, please let us know. We'd be happy to be a resource in any way. So thank you so much. And Jake, great job today as always. Appreciate it, my friend.
And thank you, Garrett. And we actually have a question for you right now. Someone is asking, what liquidity vehicles have been yielding 40 bips? Is it for balances in excess of 5 million, 10 million?
There are a lot of different opportunities in the marketplace to earn close to that and more. It depends on the time horizon of your funds. It depends on what your investment policy lays out as allowable investments. And I certainly would encourage whoever asked that question to reach out to, if they're a current client, their relationship specialist, to help them identify where those opportunities exist. And if they are not, then please reach out to us, and we certainly want to help you get the most you can. We're not a bank. We're not an investment advisor, but we do see data from all across the country that we are benchmarking. So we know what everyone's earning, where they're earning it, what to do to get it. And we want to be able to be a resource in any way.
All right. And we have a couple more questions for you here. This one says, what does the score mean to banks?
Oh, great question. I think from a banking perspective, a lot of our entities like to share their cashVest score with their banking provider, just to have more transparency and communication. There's no doubt, Jake, there's a totally different dichotomy in communication and how banks communicate and how a public entity or a higher ed institution might, and having greater information and detail into the inner workings of the liquidity position and the cash management practices of an entity can be very helpful, so that the bank can outline different opportunities that they may have to be beneficial to the entity itself.
Well, thank you, Garrett, and thank you again for coming today. That looks like all of the questions that we have right now. And once again, please, if you think of any questions after this webinar, feel free to reach out to any member of our team, and we'd be happy to answer it.
Thanks, Jake. Take care. Bye, everyone. Thanks for joining.
Take care. Have a great afternoon, everyone.